Hello, everyone. Welcome to today's webinar. I'm your host, Dara Albright, co-founder of G-Wealth Education. First, I'd like to thank Clout for assembling today's all-star panel, and we will be talking about generating income for investment clients during these times of market volatility. Before I hand over the mic to today's moderator, Jason Manchocki, who is the head of content at Cloud, I just have a couple of housekeeping items. First, this webinar will last 1 hour. There will be 50 minutes, 50, for the panel discussion and 10 minutes for Q&A. Q&A is typically reserved for the end of the presentation, but feel free to post questions as they come to you in the chat box to your right. Feel free to weigh in even if you want to on the discussion. We just hope that once you post a question in that chat box, we ask if you could just use a question mark so we know that that is a question as opposed to a comment, and that'll help us when we get to those questions. This webinar also qualifies for 1 hour of CE credit, and that's towards the CIMA, CPWA, CIMC, RMA, and CFP certifications. If you haven't done so already, please make sure to provide us with your Institute ID number so that we can make sure that you do get the CE credit for your participation. If you haven't done that already when you registered, you could email that information to ce@dwealth.education. And with that, I'm going to hand that over to you, Jay.
Thanks so much, Dar. Good morning, good afternoon, everyone. My name is Jay Manchocki, Clout by Tiffin's head of content and your moderator today. Very excited to be here to discuss how successful advisors and asset managers are indeed generating income for investment clients during these times of market volatility. Our webinar series, in conjunction with Digital Wealth News, brings together wealth management luminaries, technologists, and key operators for dynamic discussions and trends in the marketplace, and ultimately how advisors can benefit from them. But before we have our esteemed panelists introduce themselves, we welcome the interactivity in the webinar, the opportunity for you to ask questions, so please don't hesitate to do so. And then just a brief overview of what we'll cover today. We'll start out by talking about how investment managers and advisors are delivering income to their clients, whether that's through traditional approaches or alternative strategies. Next, we'll take a look at how these leaders are navigating market conditions and those risks we're taking and perhaps those worth avoiding. And then we'll transition to how clients are able to take comfort in the past given the current geopolitical instability. And finally, we'll wind down by talking about scenarios and outcomes for the anticipated Fed rate hikes and what that looks like, including the balance sheet unwind. So without further ado, I'm going to pass the baton to our panelists to introduce themselves, starting with Maggie Jandro. Maggie.
Hi, everyone. Thank you for having me. I am Maggie Jandro. I'm a financial advisor and managing partner of Jandro Wealth Management. We are a financial advisory and investment management firm located in Connecticut with 2 locations, one in Farmington and one in Westport, Connecticut. But we do service clients across the United States, proudly even prior to the pandemic. So we were able to transition really easily since we had already been using Zoom. Personally, I attended Providence College, then got my master's at the London School of Economics, and I started my career on Wall Street. I was at Barclays and at JP Morgan prior to joining my mother-in-law at Jandro Wealth Management and ultimately being her succession plan. We are proudly a women-owned and operated firm, which that does not mean we only work with women, but we certainly attract many women for that reason. And I think that's it. So I'll turn it on to my next colleague.
All right, Marcel.
Good afternoon. My name is Marcel Benjamin. I'm a fixed income strategist with State Street Global Advisors and the Spider family of ETFs. I work with clients of all stripes, helping them get comfortable with fixed income investment strategies and our suite of 38 bond ETFs in the US that total about $105 billion. I've spent about 20 years in fixed income. I worked for firms like BlackRock, Guggenheim Partners, and Swiss Re, and I've come at bonds from all angles. And I've been at State Street now for about 6 years.
Excellent. And Joe.
Hi, I'm Joe Fennessy. I'm the founder and CEO of Finalized Capital. We're a quantitative commodity trading advisor, so a little bit different than the colleagues I'm with today. rather than doing long-term buy and hold investments in stocks and bonds and ETFs. Instead, we're doing short-term algorithmic trading in the futures markets. That includes commodities, that also includes equity indices, interest rates, and currencies. So I hope to be able to offer a unique perspective at this webinar, since I'm operating in a little bit of a different space than everyone else here.
Excellent. And Ross.
Hey everybody, my name is Ross Frankenfield. I'm a managing director at Harbor Capital Advisors, where I've spent the last 16 years of my career. Harbor is an asset manager that currently has about 60 billion in assets under management. We cover a wide range of different asset classes and investment styles, and then we deliver those solutions to clients in a variety of different vehicles, including mutual funds, collective investment trusts for the retirement community, as well as exchange traded funds. And we've actually been launching several ETFs over the last year, which we're very excited about. Harbor's a little bit unique than a lot of the asset managers that you may be used to working with, in that rather than manage most of our strategies in-house, we go out and seek to identify and partner with world-class asset managers across a wide range of asset classes and investment styles, wherever they may reside across the globe. And then we seek to partner with them and then bring their solutions to the marketplace in those particular areas of expertise. And so in terms of my role at Harbor, working on the investments team, I have the privilege of working very closely with a variety of our sub-advisory partners, but also with our clients. And we have the benefit of being able to synthesize a lot of these independent, unique and often disparate views that our sub-advisors may have, and then share those insights with the marketplace and our clients in a variety of different venues, including things like webinars, as well as just typical one-on-one client meetings. And very happy to be here. Thanks, Jay.
Thanks, Ross. What a great cross-section of panelists we have representing different segments of the industry. Why don't we dive into our first topic? Dara, if you could advance the slide just one. I think this chart from Bloomberg pretty much speaks for itself. Volatility is very much here and doesn't seem to be going away soon, reflecting on the fact that the S&P has swung so wildly over the past year or so. You know, during these volatile times, it's very easy for investors to get spooked and really to begin to question their long-term investment strategies. So I'd love to hear from the panel, you know, starting with, let's say, Ross here. What have you observed? You know, how are you and your teams really helping clients, whether it be with those traditional approaches or alternative strategies?
Sure. Yeah. I mean, like I said, we have a wide range of solutions across asset classes. So in terms of mechanisms for delivering income to clients, we cover a wide range of products and asset classes. What I think has been really interesting in the current environment, among many things, certainly, is that we've kind of become accustomed to equity market volatility over the last few years in the pandemic. I mean, obviously 2020 was the ultimate, hopefully, roller coaster in terms of equity volatility. And then more recently, we've seen quite a bit of choppiness related to the growth sell-off since the Fed pivot late last year has caused a lot of longer duration, high multiple growth stocks to sell off quite meaningfully. And we've kind of experienced a lot of that equity volatility. But what I think is fairly unique to the current recent environment is the amount of volatility that we've seen within the fixed income landscape, which we really haven't been accustomed to. And I saw an interesting chart just the other day that 2 of the last 5, we've had of the 5 worst quarters for the Bloomberg US Ag Bond Index, going all the way back to 1980. 2 of those 5 worst quarters have actually happened in the last year plus. So Q1 of 2021, the Ag was down a little over 3.3%. And then Q1 of this year, the Ag was down almost 6%. And so we've seen all this volatility in the fixed income space that we haven't seen for quite some time. And then you combine that with the fact that we've also been experiencing rising correlations between stocks and bonds over the last few quarters. And that's not something that's been unprecedented. We've observed periods in the past where stocks and bonds have displayed positive correlation, particularly in areas like the 1990s. But you add all that up, and I think what it's doing is it's really causing advisors and investors to wrestle with, that sort of traditional 60-40 balanced portfolio, not only from the standpoint of, is this meeting the income needs of my clients, but is this meeting the diversification needs for my clients? Is this meeting the return potential for my clients? And so, maybe just I'll highlight a few areas that we've observed at Harbor with how advisors are trying to deal with that. On the income side, within the fixed income market, we see a lot of advisors that have just moved very short duration within their core fixed income. And I think, intuitively, that makes a lot of sense. The view here is that, the income and the yield potential at the nearer end of the curve is quite similar to what we're seeing as you extend out along the yield curve. And so, why should investors want to take that duration or interest rate risk in the current environment? Particularly, just yesterday, you had, some of the more dovish Fed members, Lael Brainard, talking about accelerating taper and sort of aggressiveness in terms of Fed tightening. The other thing that we see occurring quite a bit is investors that are stretching for yield and doing so in areas like the high yield space, as well as the levered loan market. And I think, that also makes a lot of sense with where we've been in the economic cycle, coming out of a, sharp but very short correction in 2020 in the pandemic. Last year was a phenomenal year in terms of economic growth. This year, we're clearly decelerating from peak levels, but expectations are that the growth engine is still humming along nicely. And so in those types of environments, below investment grade fixed income has typically delivered solid risk adjusted returns. That being said, we see some pockets of opportunity there. We see some areas where I think clients should proceed with some caution. Again, just a couple quick examples. Within the high yield space, a lot of investors are worried about spreads being particularly tight relative to history, and that's clearly the case. But I think one of the things that investors potentially overlook is the improving credit quality that we have seen in the high yield market over the last several years. Just looking back a couple of years, the percentage of double Bs within the high yield market has increased by about 15% and now makes up more than half of the overall index. And so even when we have similar levels of spread vis-a-vis a few years ago, the credit quality has improved materially. And so we see some pockets of opportunity for generating income in volatile markets in that venue. On the levered loan side, I think that would be an area where we would, suggest that investors should proceed with a little bit more caution, just in the sense that the amount of flows that have gone into that space have been astronomical. If you look at the Morningstar categories, there's about 134 Morningstar categories. Bank loan funds and ETFs have been the 8th best-selling category over the last year, taking in more than 50 billion in assets. And that just gets you a sense of how much advisors fear interest rate risk. They don't want duration risk. But one of the things they should be mindful of, in our view, is that, below investment grade, whether it's high yield or levered loans, does come with significant credit risk. And, so as we navigate the Fed tightening, as we navigate a slowing economy, if the Fed makes a policy mistake and throws us into a recession, investors just need to be mindful about the credit risk that they're taking there with an area like bank loans. Just over last year, the average bank loan funds returned about 2%. And so you're not getting a huge upside for avoiding that interest rate risk. But if you look at the first couple months of the pandemic, levered loan funds were down, 20+% on average. And so there is a lot of downside risk, asymmetric risk there to keep in mind. And then lastly, before I pass the baton on to some of my colleagues here, from a diversification standpoint, what we're seeing a lot of investors doing is really starting to think about, again, thinking about that hypothetical 60-40 balanced portfolio with the concerns about bonds and stocks potentially being more positively correlated. Investors are thinking about adding other asset classes that may display low levels of correlation to these main asset classes. And one area we're seeing a lot of interest in, and Joe can certainly speak to this probably much more than I can, is in the commodity space. Obviously commodities are doing very well currently, just given the scarcity issues related to the emerging from the pandemic and the Ukraine Russia war. But I think what we've also observed is that commodities have been a useful diversifier across portfolios across multiple periods in history. And just to end with one fun fact, just in terms of the diversification benefit that commodities can provide, if you look at year to date, so just in the first quarter here, as you mentioned, Jay, equity volatility has been quite high. There's been a lot of choppiness. There's actually been 16 trading days where the S&P has had a return of -1% or worse. Across those 16 days, the Bloomberg Aggregate Bond Index has only had a positive return in 6 of those 16 days. Whereas if you looked at a broad diversified commodity index like the Bloomberg Commodity Index, it's had a positive return in 12 of those 16 days. And so there are other ways that I think we've observed investors are looking to add, sort of the zig to equity zag that helps to dampen risk in these volatile markets. So I'll pause there and, happy to pass the baton.
Fantastic overview, Ross. I think it's a good natural segue to pass that baton to Joe. Given the uniqueness of your business, would love to get your thoughts on this topic.
Yeah, absolutely, Ross. That was the perfect segue. So since I am in the alternative space, I have a little bit of that different perspective. Stock market volatility is inevitable. It happens all the time. Some years there's more volatility, some years there's less volatility. But in general, bond market volatility has not occurred at the same time. So traditionally, investors have diversified out of the stock market by investing in the bond market. And this might be directly, this might be through ETFs, through mutual funds. The package doesn't matter so much. But investors have had the diversification. So if stocks are going down, typically bonds will go up, right? The Fed will cut interest rates, that will push bond prices up. But this time is a little bit different because bonds are already, well, prior to the past few months, they were already at historically high levels because interest rates were at 0, right? So now in this bout of stock market volatility, we haven't seen that same level of price movement to the upside in bonds. And in fact, we've seen the opposite, price movement to the downside in bonds. And this kind of points to the fact that stocks and bonds, they're not the only two games in town. Alternative investments are more important now than ever. You could make the argument in client portfolios to be able to hedge against volatility in both stocks and bonds at the same time, as we've seen so far throughout the first quarter of the year. So this does include commodities, right? Certainly just being long commodities, long gold, or even long oil or agriculture commodities can help to provide diversification. But there are also more complex strategies within the commodity trading advisor space that can add similar levels of diversification with possibly a little bit better of a return than just outright holding the commodity. So I'd encourage listeners of this webinar to maybe look into some of those different strategies. I don't want to pitch myself, obviously, but Finalize, we do partake in those type of strategies in the futures markets to provide that diversification to clients who are looking to not be overly exposed to the stock market or overly exposed to the bond market.
Excellent. Thank you, Joe. Ross or Maggie, any accompanying thoughts and perspectives? I'm sorry, Marcel, that is.
Yeah, sure. I'd like to echo some of the things that Ross spoke about, but also differ with him on a few points. Certainly what we have seen from our client base and speaking to advisors and investors is really that this year you need to have some intentionality around your duration positioning. As was mentioned, the ag was down about 6% in the first quarter. I don't think anyone's calling for that to repeat for the rest of the year. But 6 times 4 is 24, and if we were to see another reprise of Q1, it will be painful for investors who have traditional fixed rate duration exposure. And so there needs to be intentionality around that because we've been in a very long bond bull market, and so we are having a lot of conversations with investors about reducing the duration profile of their portfolios unless they are very intentionally, tracking the ag or some type of other exposure. And there's quite a few ways to do that. One thing to keep in mind is that for the first time in a long time, investors are going to be paid for holding cash or having ultra short exposures. Investors, can actually allocate to T-bills for the first time and get returns above zero. And then on the floating rate note side, there are both investment grade floating rate note strategies that we offer, as well as what Ross spoke about in terms of bank loans, also called senior loans or leveraged loans. And those are below investment grade. But all of those floating rate notes or senior loans benefit from having these coupons that are resetting every, say, 1 to 3 months, and seeing the benefit of higher LIBOR rates. 3-month LIBOR recently crossed above 1% for the first time in several years. And so they're harnessing these higher coupons, and then they don't have that traditional duration risk, that interest rate sensitivity that most fixed rate securities in the bond market do have. And then if you think about the forward trajectory of short rates and what the Fed has been announcing, there's probably close to another 2% of hikes in the near term that will come. And again, investors will benefit from those higher coupons as those coupons reset, again, every 3 months or so. And then if you think about some of the volatility, as was mentioned, it is duration driven. So, being able to mitigate some of that through various strategies around reducing your duration is important. But also going into this year, we saw a lot of investors looking for high inflation adjusted or real income strategies. And so we offer a number of those around such asset classes as high yield, preferreds, convertibles, and emerging market debt. So there are quite a few different levers that investors can use around a traditional high grade core bond portfolio to increase income. And notwithstanding the fact that rates are higher than they have been, in the recent past, we do find that investors continue to be starved for income and looking for a number of different diversifying income strategies. I'll pause there.
Well, very much appreciate those inputs, Marcel. I think it's a great jumping off point to kind of weigh into our next topic and how leaders are really navigating these market conditions, asset managers and advisors, and what are those risks worth taking and those worth avoiding. So with that, I'll pass that baton to Maggie. Would love to get your thoughts on this topic.
Sure. So I will come at this at the psychological or emotional piece of investing, right? And maybe share some of the best practices that we use with our clients as we go through these tumultuous markets. I think everyone on this call would agree that you want to have a well-diversified portfolio. I think my colleagues have already shared some interesting perspectives on, at least on the fixed income side, on how to diversify. But obviously the same goes with your equity side. What we do with our clients to keep them calm during these markets is remind them that it is time in the market and not timing the market, and remind them that is why we work so diligently, even through the good markets, to ensure that their asset allocation is indeed in line with their expectations, with their risk tolerance, so on and so forth. One program that we implement, and I think it works very well with our clients, is using a tool called Riskalyze. And the reason that I like it is because you input your client's portfolio, and then you're able to show them historical scenarios of how their portfolio would perform, whether it's 2008 or 2013. And then we have some meaningful conversations. If another 2008-like scenario would occur, are they comfortable with their current asset allocation? Another tool that I like to use, and I'm sure everyone has seen this too, but again, it's very effective, is that sort of patchwork quilt that many asset managers release, where it shows how different asset classes have performed over time. And I think it really drives home the fact that we don't know which asset class is going to do well next year. But we do know that a well-diversified portfolio, while it may never be the winner, it usually is also not the loser in any given year. So those are sort of our best practices. I think it now more than ever is an important time to look over folks' asset allocation. As my colleagues mentioned, the economy is, and the markets are still poised to do well due to some fundamentals, but we don't know how interest rates, as they rise, how that's going to impact the markets. It can sort of go either way, what most analysts say. And I know that's a topic we'll be covering. So it is important now to prepare clients emotionally for the volatility that is going to continue. Another thing that I remind clients of is that often the market recovers faster than the economy does, or faster than consumer sentiment believes the economy is recovering. Vanguard has a great piece which really shows to not believe the headlines, and it indicates several really bad headlines about unemployment, about the housing crisis, all throughout the market recovery. And if clients had waited until the headlines are rosy, they would have missed out on about 2 years of growth in those situations. So another example that I like to cite is literally what just happened in 2020, right? Had any client pulled out on the one worst of the market, which was, I think, March 16th, the S&P 500 fell that one day by 12%. By March 23rd, the S&P hit rock bottom at 34% since February. And so if any investors had panicked during that time and then pulled money into cash, they would have missed one of the best market days, not only in the year, but in all time. I believe the Dow, it was said that on April 9th's performance of the Dow was one of the top 10 in history. Again, on April 9th, 2020, according to FactSet. So most investors, had they pulled out during that bottom, they likely were not ready to come back in 2 weeks later or 3 weeks later, and they would have missed some of that great upside. And then, of course, the last resource I always like to coach my clients with is, again, many folks on this call probably know, but a nice reminder, is many of the examples of how a well-diversified portfolio that doesn't pull out of the market, that rides through the good and the bad times, how it tends to do better than if someone misses just the 10 best days, the 20 best days, so on and so forth. So again, now's a very good time to be thinking about risk, to be thinking about clients' goals, and also to be making those changes now as markets hopefully stabilize versus ahead of any sort or after any sort of recession. So with that, I'll turn it over back to my colleagues.
Great commentary. Thank you, Maggie. Ross, I'd love to get your thoughts here.
Yeah, I mean, I really like, Marcel, your comment around intentionality related to duration strategy. And I think as it relates to the topic here of what risks are worth taking and what risks are worth avoiding, I think intentionality is really important as well in this environment. And I think what we would stress is that you'd want to be taking risks that help protect the purchasing power of your income and your income needs, as well as potentially taking risks that help to ensure proper diversification from a risk management standpoint. So those are two areas that are not tactical type orientations, but more around ensuring that your long-term strategic asset allocation decisions related to goals and risk tolerance are in alignment. Because one of the things that we have observed is that volatility in markets can really swing things around materially. And if you're not keeping an eye on your positioning, things can get a little bit out of balance. And so, one area where we would, suggest is a reasonable way to protect the purchasing power of income needs, a little bit different from the fixed income discussions that we've had, but more on the equity side, is the utility around dividend and dividend growth strategies in this type of an environment. There are a lot of strategies out there, a lot of companies that are, fairly less sensitive to the economic cycle in terms of their ability to raise dividends consistently over a long period of time. So that provides some potential defensiveness from those equities in choppy markets, but it also provides a useful inflation hedge where we haven't, as investors, had to really think about inflation risk in most of our careers or investment lifetimes. There are a lot of companies that have had the ability to grow their dividends faster than the rate of inflation, even in a year like 2021, where inflation, as we all know, clearly accelerated to the upside. The other benefit for dividend income oriented strategies is that many of these companies are kind of stable, steady growth businesses that didn't experience a lot of the rapid multiple expansion that we saw in that fastest growth, highest multiple cohort of the growth universe that's really been self-correcting since the Fed's been tightening. And so we see that as a useful area to maybe make some tactical adjustments in terms of protecting that income purchasing power. In terms of taking steps to ensure proper diversification, I think this is really just the simplistic taking a look at client portfolios and making sure that you haven't drifted materially either in terms of equity fixed income allocation, but more importantly, probably within the equity sleeve, that kind of growth versus value dynamic. Up until recently, growth was on a multi-year run versus value investing. And I remember, before Q1 of last year, there were a lot of media articles talking about value being dead again. And since then, we've seen quite a bit of a rotation. And you could even make the argument, a lot of, style is in the eye of the beholder. There's a subjectivity to it. But you could make the argument that a lot of our most well-known core benchmarks, like the S&P 500, have become much more growthy over time. There's really no release valve for companies migrating out of the S&P 500. And so you have this rising concentration of mega cap growth oriented companies. And so I think, with that, ensuring that there's a balance is useful. Value and growth stocks displayed very low levels of correlation last year and into this year. And I think one of the additional benefits of value stocks today is that, they haven't been particularly correlated with bonds this year. And so what a lot of people are talking about is rising correlation risk between the S&P 500 and the Bloomberg Ag. But areas like the Russell 1000 value have continued to display that negative correlation. And so, that's an area that I think, can help investors maintain that proper diversification, dampen some risk amidst volatility. And then the last kicker related to value stocks in terms of their utility related to, the overarching topic of this webinar, income needs, is that value stocks are offering a higher level of dividend yield relative to the S&P 500, certainly relative to the growth universe. And so that can be a way to add some incremental yield as well, in addition to having a little bit more of a margin of safety. Margin of safety has always been a key component of value investing that really kind of went out the window in the early stage of the pandemic, almost coincidentally, because a lot of the companies in the value index just happened to be companies that really were hard hit from global lockdowns. And so, those are a couple areas we would suggest it's makes some sense to introduce potentially some risk. I would say some areas to avoid would just be, as I mentioned, not sort of bank loans or high yield in general, but the more lower rated areas of those marketplaces in a decelerating economy. You never know what is going to crack first, and so I think investors will benefit for having a focus on quality in some of these riskier areas of the marketplace. And then, this may sound a little self-serving, but I think an area to avoid is being overly passive, particularly in the equity sphere. I think conventional wisdom has been that, you want to go passive in large cap US equities and go active in less efficient areas like international small cap or US small cap or emerging market equities. And if the pandemic's shown us anything, 2020 was a banner year for active managers in areas like US large blend, US large growth. And so, particularly given some of the concentration risk we're seeing that's really been building up in some of these large cap indices, we look at this as an opportunity to not be tethered to some of these growing risks that might be that investors might be a little bit less aware of when they're passive investing, thinking that they're getting very, very broad diversification, where in fact some of that diversification has become more concentrated over the last few years.
Jay, if I could just chime in as well, I think you might be on mute. One thing that Ross brought up, and I'm going to speak a little bit out of turn here because I do focus on fixed income, but I know that we have a strategy of fund that really concentrates the portfolio around something called dividend aristocrats, and these are companies that have grown their dividend consistently over the last 20 years. And again, it's a little bit out of my wheelhouse, but I do want to echo, I know that's a popular strategy, and it's a strategy that could make a lot of sense in this type of environment.
Excellent. Great insight. Thank you, thank you both, Ross and Marcel. Before we turn over to our next topic, just want to remind the audience that we welcome the interactivity. If you'd like to throw a question or two into the chat box, by all means, we're here to answer them, and very pleasantly surprised by the cross-section of the audience as well. People from E-Trade, people from Fidelity, and an array of RIAs. So thank you all for attending today. Switching gears to the next topic, and that is, how can clients take comfort in the past amidst this geopolitical instability? It's certainly nothing pleasing to watch what's going on in Ukraine. However, it is important to note that, market corrections pullbacks are cyclical. They're common. And in fact, I was just reading a recent Forbes article that mentioned since 1928, a correction of at least 10% has happened in the S&P about once every 19 months. So amidst this tumultuous times, how do you coach clients to take comfort in the past? Maggie, why don't we start with you? We'd love to hear your thoughts.
Sure. I think, as you said, you always have to remind clients the past doesn't necessarily predict the future, but I think clients can get comfort from situations that were similar and how did the markets react in those situations. So there was some really great research put out by LPL right after this occurred. It was called 11 Things to Know about Russia and Ukraine. And they looked at 37 major geopolitical events since World War II. And they showed how the markets reacted after each geopolitical event, 1 month, 3 months, 6 months, and 12 months. And so long as the economy or the markets were not posed for a recession when that event occurred, which again, we could argue that our economy was not poised for a recession, right? We were just coming out of one. A lot of economic fundamentals are quite strong currently. So long as we're not poised for a recession, we have seen an average recovery 12 months later from a geopolitical event like Russia invading Ukraine of an average of 10.8%. So I think, again, the past can't predict the future, but seeing that and pointing out to all of these different events that are quite similar to what's going on now, because geopolitical events have always occurred and unfortunately will continue to occur, I think is one place to really provide comfort to clients. The other thing that I always hesitate to say, just because I don't believe that war is ever the answer, just given the human cost, government spending is a key component of GDP, right? And so typically when wars occur, it increases government spending and therefore increases economic growth. For example, large cap stocks during World War II returned an average of about 16.9%. During the Gulf War, large cap stocks were 11.7%. Similarly, small cap stocks, World War II, almost 33%. So markets do tend to do well during times of war. And by the way, in both of those examples, inflation was elevated as well. Certainly not where it is now, but during World War II, inflation averaged 5.2%, for example. So I think that really helps many clients remember that we've been here in the past. And ultimately, while, make no mistake, these sorts of events do cause a lot of volatility in the short term. But in the long term, the overall impact of geopolitical events on markets tends to be not as impactful as maybe we're feeling in a given moment. Furthermore, looking at this particular situation, right, we can all probably agree here that oil markets were primarily impacted when it comes to markets. We are happy to say that the U.S. doesn't really rely significantly on Russian oil in the way that Europe does. And that kind of goes back to our diversification, right? You don't want to be all in European countries because now that you'd be hurting pretty significantly. So I think looking at the past and just reminding clients of situations that were similar is very helpful.
Very insightful. Thank you, Maggie. Marcel, we'll throw it back to you. Your thoughts.
Yeah, Jay, I'm going to approach this from a slightly different angle. One of the things that's I find is paramount in these types of environments is to know what you own. And one of the benefits of the ETF wrapper, and certainly for our fund lineup, is that we publish all of the holdings of all of our funds every day on our website and on our website and our third-party distributors as well. And so, when Russia invaded, I think there were certainly some client questions, but they tended to gravitate around our bond funds that are global or emerging market in orientation. And certainly we had some exposure to Russia and some of the other countries in that region in our emerging market debt strategies, perhaps in some of our global bond funds. But these tend to be index strategies, very transparent, and you know what you own. And you can see your holdings every day. On the flip side, there were some headlines out there for some mutual fund managers that investors may have been surprised to know that they had significant exposure to Russia. In fact, there was one manager out there who was selling credit default protection, insurance protection to Russia. And so it really just comes down to knowing what you own, having that transparency, being able to have very sort of targeted exposure. So if you want to allocate to emerging market debt, you can do so through this ETF wrapper, through a strategy that is dedicated, through a fund that is dedicated to that strategy and not sort of mingled in with a number of other exposures. And then for some clients, we do have active strategies where, again, they can leverage the knowledge and acumen of a brand name sub-advisor, but it really comes down to knowing what you own and being comfortable and intentional about your exposures.
Fantastic. Well, that leads us to our final topic today, and it was just roughly a week ago that we had the first Fed rate hike since 2018, and it's one of anticipated more to come in the coming weeks and months. So with that said, I'd like to perhaps start with Maggie here. Your thoughts about the scenarios and outcomes for future anticipated hikes and that balance sheet unwind.
Sure. So I think, we shouldn't be seeing anything that's surprising necessarily at this time. I think the Fed has tried to be very transparent about their rate hikes, and we saw a lot of that priced in, this January, when we already knew the Fed was going to increase rates. Many folks that I spoke to, many analysts believed back in January, those hikes were going to be even more than now. I think the latest number I heard was 7. In January, some people are saying 9. And so obviously we don't know, no one ever knows exactly that number. And I'm not going to sit here and pretend I have that crystal ball. But I think, as all of our colleagues on this call have said, we want to make sure you understand what you own, and that your bonds and your fixed income is positioned correctly for these rate hikes. So I know many folks had invested in floating rate at maybe a little bit earlier in the year, which could protect as interest rates are increasing. So I'll.
Ross.
Yeah, maybe Jay.
Yeah, Marcel, please.
Yeah, sure. So maybe just a quick recap of where the Fed is at this point in the cycle, and kind of what we're seeing and what they've done. And there's news coming out every day on this. So if you go back to June, basically nine months or so ago, the Fed itself was not anticipating any rate hikes in 2022, and that's pretty remarkable because over the course of the last 9 months, the pivot has been very dramatic. Certainly, I don't want to call it unprecedented, but atypical of what most folks who are investing today have ever seen in their lifetimes. And so now you have a Fed that actually, I remember back in January, Goldman Sachs called for 5 rate hikes for 2022, and at the time that seemed like quite a few. And now we've had 1 hike where the Fed minutes were released yesterday, and they said they actually would have liked to do 50 basis points at that hike, but they were a little bit concerned about how the market would react to that in the face of the geopolitical conflict. Major banks such as Citigroup and JP Morgan are now calling for 50 basis points at each of the next two meetings. Citigroup, in fact, is calling for 50 basis points at each of the next four meetings. And the 50 basis point hike, I think, has over 90% expectation right now for the next meeting. So certainly, I think we should expect 50 bips at the next hike. And then subsequent hikes later in the year, maybe smaller, maybe 25, and then more to come in 2023. And then also yesterday, an announcement that the Fed is looking to, once they begin a runoff of the balance sheet, and over the course of, say, 3 months, get to a cap of $95 billion of securities, split maybe 2/3, 1/3 between treasuries and mortgages in terms of runoff. Because they now have a $9 trillion balance sheet, and they need to shrink that. And so we were talking about volatility at the beginning of the call, and I think this ties back well because we have seen elevated interest rate volatility, multi-year highs. And the Fed is effectively saying that, before too long, they're going to remove themselves from the mortgage market. And so now for some years, we've seen a price insensitive, indiscriminate buyer in these securities. The Fed has just come out every month and bought fixed income securities. They don't care what the price is. They're just there to support the market. And now they may come to a point where they'll be selling mortgage securities, although they haven't said that just yet. But certainly they're going to stop buying them altogether, probably before the end of the year. And that's only going to probably lead to more volatility. Because again, they have a very supportive role in when they were engaging in quantitative easing. So the other thing to keep in mind is that the last time that the Fed paused in their purchases, which they really just finished last month, the purchases that they've been scheduled with the last 20 billion, they held that balance sheet stable for quite a long time. They waited quite a long time before hiking, and now they really find themselves behind the curve here, late to the game. So quickly after they've stopped purchases, they went and hiked, and it seems like only a few months later they want to run off this balance sheet. So this is very unprecedented. It's the removal of a tremendous amount of stimulus, but obviously they're concerned about inflation. They see that the jobs picture is quite strong, and they have to keep that dual mandate in mind. But investors are certainly, as we talked about at the beginning, losing money because of higher interest rates. But also presented with some opportunities. Like I said earlier, cash, it pays you for the first time. So whether that's an ultra short exposure or T-bill exposure or something with extremely low duration, less than a third of a year, like a floating rate note exposure, there are many ways to position around this.
Fantastic recap, Marcel. With a minute or two left before we open it up to audience questions, Joe or Ross, any perhaps Joe, would love to hear from you again. Any closing thoughts on this topic?
Yeah, so what we've seen the past couple of years in terms of monetary policy is something that we certainly haven't seen since, at least within the 21st century. You could possibly go back even further. And this time it's a little bit different too, because prior to maybe the late 90s, electronic trading wasn't really a thing. So markets are very different today than they were back then for that reason. And what we saw in 2020 with essentially QE infinity by the Fed, cutting interest rates to zero and massive asset purchase programs, is we saw all asset classes surge, right? And this is in large part due to the fact that there's more dollars chasing fewer goods, right? So I went to University of Chicago, and Milton Friedman, one of the most prominent economists of all time, he was a professor at University of Chicago. He has a famous quote that inflation is everywhere and always a monetary phenomenon. So there are competing theories, of course, but with so many more dollars in circulation, all sorts of various asset classes rose together. And I bring this up because today the Fed is in some sense undoing part of their mistake of 2020 of maybe going a little bit too hog wild on the monetary stimulus. They're starting to pull that back. They're starting to raise interest rates. And there's talk just yesterday about starting to let the balance sheet run off. So shrinking the balance sheet, essentially removing some of those dollars from circulation that they printed will be the net effect of this. And that could lead us to a situation where, as 2 years ago, all asset classes rose together. We might see a situation now where all asset classes fall together, or maybe not necessarily fall, but their growth will be muted across a variety of asset classes. So I think that's why it's important to take a look at alternative investments, because there are investments out there that can still do well and profit, even if asset classes as a whole are not rising, right? So short-term trading strategies like what Finalize does, and there's plenty of other firms that do it too, we're agnostic to the overall direction of the market. So we didn't really benefit from the overall rise in asset classes, and we wouldn't suffer from an overall fall in asset classes. So just another thing to keep in mind for the attendance of this webinar, to keep in mind that monetary policy, because it's so extreme today, we could have large scale movements across all asset classes, and you might have to work a little bit harder to get diversification than you did in the past.
Makes good sense. And very,
Jay,
very
just one thing that I'll just close with. I think, one of the things I think this should potentially serve as a cautionary reminder to advisors or investors is that, even the experts, the Fed and others, do a pretty terrible job of trying to forecast interest rate movements. And ultimately, the interesting thing is that, in the past several years, the Fed has said, we don't really know where rates are going. We're going to just chase our tail, but we're going to be really transparent about what we're going to do as we kind of chase our tail. And so I think one of the things that potentially lends itself to is, within a core fixed income exposure, not to be very fearful of duration neutral strategies, those strategies that just try to take the interest rate macro guess game out of the picture and just focus on bottom up security selection where a manager might have some value to add. And one other, sort of data point that I'll just close with related to that is that, again, history is not necessarily a forecast of the future, but because the Fed has been so transparent for the last several years, if you look at the last two Fed rate hike cycles back between 04 and 06 and then 2015 to 2019, once the Fed lifted off, if you then looked at what happened to yields across the yield curve from the 1 year to 2 year to 5 year, 10, 30, there was very little upward movement at the 10 year and the 30 year. And in fact, in both of those cycles, you actually had flat or sometimes declining yields at the long end of the curve because of the fact that markets tend to anticipate, especially when they're being told by a Fed, this is what we're planning to do, planning to tighten. And so I think just as something for investors to keep in mind, because again, you do see a lot of fear around interest rate risk being one of the biggest fears that investors are talking about. But coincidentally, the last two times the Fed hiked at the front end of the curve, all of that yield increase, or the majority, happened at the front end, not the long end. And if you looked at different categories, short-term, intermediate-term, and long-term categories, it was actually long-term bonds that did the best during that actual Fed hike cycle. And so, again, just a little bit of a food for thought in terms of maybe not trying to be a hero in terms of tactical interest rate decisions.
Good points. Thank you so much, Ross. As per usual, at the last few minutes, the questions from the audience are trickling in. And so I want to take the next 3 or 4 minutes to answer those, while at the same time giving Dara some time to talk about the CE credits that are available for the attendees today. 2 questions that just popped in. One, and perhaps Joe, you might be well suited for this. What alternatives do you think will perform the best? And the subsequent question, time permitting, one audience member, Mike, mentioned that we haven't heard too much about muni bonds or closed-end funds. Are either of those attractive in this environment? And do you recommend them and why? Favorites, perhaps. Why don't we start with alternatives?
Yeah. So what we've seen over the course of the past year is commodities have been the best performing alternative. So a lot of that was due to supply chain disruptions, and then that was most recently exacerbated due to the conflict in Ukraine and the resulting sanctions. So what's interesting about the alternative space is it's very broad, right? It's hard to put all alternatives under the same umbrella. So some alternatives do have a strong correlation to the overall economy and to the stock market. Real estate would be a good example of that. Real estate, in some sense, being even correlated to interest rates, because as interest rates rise, mortgage rates go up, and that's a negative pressure on real estate prices. So, and then you have venture capital and private equity, which are kind of like stock investments, just with smaller companies, right? Whereas commodities, it's a lot more of a separate animal altogether. And then going even further than that, if you're looking at algorithmic trading strategies that don't have any sort of directional bias, that's where you can get a lot more correlation and diversification. No one knows which one's going to do best moving forward, right? No one has a crystal ball. But diversification and trying to find uncorrelated investments, this is a tried and true method in finance that has worked for a long time, and everyone sort of agrees will continue to work moving forward.
Thanks for that, Joe. Appreciate it. With 2 minutes or less, would anybody like to field a question regarding muni bonds or closed-end funds? Are either of those attractive in this environment? Do you recommend them? Favorites, perhaps?
I could chime in on munis. Certainly munis do have a place in the portfolio of investors who have tax considerations. And what we have seen this year is that, as with nearly all other fixed income or fixed coupon investments, they've also been hit. And all curve muni strategies are probably down 6 or 7% year to date. Now, typically investors should not be looking at munis as a capital appreciation play, but more as a tax-free income and alternative. And so, if you are allocating to munis today, you will be getting higher you'll be getting higher income rates, higher yields, and higher tax-adjusted yields. But you have to bear in mind that if interest rates continue to rise, you may lose more price there. And so I think, again, there needs to be some intentionality. If you don't have conviction about the level of interest rates, if you are concerned about interest rates going higher, then you can allocate to shorter duration, shorter maturity muni instruments. But it may be a good entry point today when the longer duration munis are down 6 or 7% to allocate if you've been underweight to that sector. But you also have to remember that duration remains one of your key risks in munis.
Great guidance, Marcel. Thank you so much. As we near the close here, I want to take a minute to thank not only our panelists, but all the audience members and the great cross-section we had. I just noticed a few more friends from LPL and John Hancock. Really impressed by the diversity of the attendees, as well as the makeup of the panelists. Next month, we'll have yet another edition in our webinar series. I believe this next one's going to focus on bolstering stickiness and engagement with your audiences and those advisors and asset managers that are doing it well. With that said, thank you so much, everybody, for attending today. I'm going to pass the baton back to Dara so she can just have some closing commentary if she wants to share that slide on continuing education credits.
Sure. So I just want to say thank you to the panel, because this was really a phenomenal session and really very educational. Just going to get that last slide up there just to make sure anyone who's seeking the CE credit for your CIMA, CPWA, CIMC, RMA, or CFP certifications, just please make sure, if you haven't done so already, to provide your credentials and institute ID number to ce@dwealth.education. But thank you again. It was really, really insightful panel. A lot of great nuggets of information in there.
Well, wishing everybody a great close to the Thursday, and stay tuned for the next edition of Digital Wealth News and Clout by Tiffin's webinar series. Thank you all.
Thank you. And thanks everyone for attending.
Everybody.